Welcome to the Money Mastermind Show. Let's talk money.
Welcome to the Money Mastermind Show. I'm Glenn Craig of Free From Broke, and I'll be your moderator tonight. Here are our panelists on the Money Mastermind Show, the people that make it up. We have Kyle Prevost of youngandthrifty.ca, Miranda Marquette of Planting Money Seeds, and Tom Drake of Canadian Finance Blog. We usually also have Peter Anderson of Bible Money Matters, but he wasn't able to make the show tonight. We have a special guest. We have Robert Farrington of The College Investor. Welcome to our show, Robert.
Hey, guys. Thanks for having me.
Thanks for being here. For today's topic, we're going to go over putting your money to work for you. And before we jump into that, anybody that's out there watching live, there's a Q&A app on our Hangouts page. Feel free to ask any and all questions pertaining to putting your money to work for you. We love getting to viewer questions, so please feel free to do that. So, putting your money to work for you. Why have your money go to work for you? Why not let it be lazy and just lay around somewhere? Let's go into that. Robert, since you're our guest, tell us a little bit about why we should have our money working for us.
Definitely. I mean, I kind of start us off with a story, and it's one of the things that really struck me and one of the reasons why I want to invest. And it actually happened to my friend's mom, and she was very conservative and just did not want to invest her whole life. So she had her company 401k, and she just put it in like the stable value fund, which is effectively just a savings account. By the time she got to be 65, she only had about $300,000 there and just wasn't ready to be able to retire because over 25, 30 years, her money didn't grow. So for me, there's a risk in not investing as much as there is a risk in investing, but I think the power of compounding and watching your money grow over time is so huge.
So basically, there's better things that we can do with our money, and if we're looking to have a nice retirement, we need to find ways to make that money grow a little bit better then.
Definitely. Like 0.5%, 1% doesn't get you to where you want to be. Your money's not working for you. So you want to make your money work for you.
So let's go into how we can get our money to work for us. What are some ways that we can start off doing that?
Definitely. I mean, I think the biggest thing is just really just start investing in the stock market. I mean, it has outperformed all other investment vehicles over, the long term. So when we're talking the long term, we're not talking a 1-year period or 5-year period, but 20, 30, 40 years. So getting invested in the stock market really is the way to go.
That can be pretty scary, though, for a lot of people. You hear all these horror stories. Certainly a lot of people are getting filthy rich over the stock market, but a lot of people get wrecked over it, too. How would a person get started in that?
Definitely, and you can, and that's where it's keeping it simple, sticking with index funds, investing in the broad market. Where I think people do get wrecked is when they're trying to trade and they're not doing their homework and they're investing in products they don't understand and they're taking advice from people that are in it for big commissions versus their own well-being.
Yeah, I think that's a big deal. I mean, Warren Buffett talked about, one of his pieces of advice was you have to understand what you're investing in. It's one of the reasons why he never got into derivatives when people were making stupid amounts of cash on them, and on paper they looked really wealthy, but he called them weapons of mass economic what was it?
Destruction.
Yes, thank you. Or something to that effect. So yeah, I think that's a really good point, Rob, that you do want to start out with something that you understand, and I think an index fund is a good way to start because it's something you can understand, it's something that's easy, it's something that's inexpensive. You get started in that, and you can start learning about other things and getting educated before you move forward with more in-depth type investments.
Definitely,
yeah.
That's key.
The problem with recommending an index fund, which I'm a huge fan of, I've written an ebook on it and stuff, is that it's just not sexy. It's boring. You're not gambling. You're not throwing it all on 15. You're not waiting for the new Apple unveiling to see if you can add 20% to your stock overnight or whatever. And so people, they want that gambling rush, right? Instead of, taking $25 to their weekly poker game every night and satisfying that part of your human DNA, they get that by gambling their retirement savings in the stock market. And I just don't think that's a good idea to initially to start off, like you were talking, Glenn, to be essentially betting that you can pick stocks better than someone else. That's a huge bet when you consider who's on the other end of most trades for me.
And I think people forget that too. It's just when you buy something, it means that someone else is selling it. So you have to ask yourself, why are people selling it?
That's a good point. And I think you also bring up another good point of having somebody on the other side of that. Why are they selling it? When you're investing in an index fund, you're looking at the market as a whole and saying, well, here's something that I'm going to base the entire market moving forward on. So it's more of a collective thing, and it's more of if the market as a whole does well, then I do well. And it doesn't have to be based on, well, somebody's selling something, why, like Rob said, why are they selling it?
And those are the
it's easier. It's easier to be average than to try to actually beat the market and find that tech stock or anything like that for sure.
And we've been talking a lot right now about index funds. Let's not forget that even index funds can go off on all sorts of wild different directions, that it's not necessarily even as safe as some other index funds. There's a whole range of different ETFs and funds and so on and so forth. But I think we're getting almost a little bit more advanced at the moment. And let's talk about different types of investments and where you might want to put your money, like different places that you could start making your money work for you. So an index fund is one type of thing you can buy, but what type of account are you really going to put it in? I think a lot of people get confused about that.
Definitely. I mean, I think that it starts for most, at least for most Americans, with their employer-sponsored accounts. So the 401k, 403b. I think that's where it starts. And at least in that situation, your employer defines, about 10, 15 different funds that you can invest in.
And that is a real easy way. Some people might even be investing in their 401k or 403b and they don't even realize it. But bam, you're in the market right there in some way, shape, or form.
Exactly.
What are some other places? So besides, you got your 401k, your 403b, some other retirement type of accounts.
Definitely. I mean, beyond that, then it's looking at your IRA. So let's, do the Roth IRA, a traditional IRA, whatever makes sense for your tax situation. You can invest just in a standard brokerage account, so you don't get any tax benefits, but it's basically the name of an account. You have your checking account, your savings account, and your brokerage account is what lets you just invest in the market. And then you could save for education too. So there's special accounts that allow you to save for your kids' futures as well.
And I think another thing that a lot of people overlook because they're relatively new, but I really like the health savings account as an investment account. You do have to qualify to open one. You need to have your high deductible plan, and you need to be able to handle that higher deductible and handle that kind of thing. But it actually acts as another IRA. If, once you hit 59 and a half, once you get to that retirement age, it can act as a traditional IRA in addition to being, your health savings account, your medical expenses. So really, I like to divide it up. And once you get to a certain point, most health savings accounts, most of them have a threshold of $2,000. Once you have that $2,000 in there, you can start investing in an index fund with your health savings account money and really start seeing that compounding interest grow. So I think the health savings account is something a lot of people overlook, but it's still there. It's got tax advantages, and it's a really great account if your finances and your circumstances are conducive to using one.
I'm going to get a little basic here and ask, does your savings account have a place for putting your money to work for you? You do get some interest, and depending on what's going on in the economy, you could get a nice little bit of interest there. Does that have a place in your overall portfolio there?
I think it plays a big role, and it also depends on where you are at in your life. So as you're younger, I think you keep your emergency fund in a savings account or CDs, something similar, have a little stockpile of cash. But then as you go older and you're looking to start needing more money to live off of from your portfolio, you should have more and more of it in your savings account, more and more of it in cash.
With all the mention of some of these American accounts, I should point out in Canada, we've got the RSP, which is more retirement-focused tax shelter for your money. But the TFSA is an awesome account where you put the money in, you don't get a tax credit up front, but it grows tax-free. So you can pull that money out whenever you want, and it's great. I use it for my stocks.
The nice thing about the TFSA is you can like transfer your contribution room. So I think that's a good thing to point out to the Canadians, because that's something that, you know, a lot of people compare the TFSA to the Roth IRA. But the nice thing about the TFSA is you can roll over your contribution room and you can build that up. So if you miss a couple of years, you can go back and get that get the tax-free growth advantage. So I think there's a lot of cool things to do with the TFSA.
Oh yeah, not only can you roll it over, but what you pull out, you can put back in the next year. So if you withdraw $5,000, you get that room back again the next year. So it's not only rolling over the annual amounts, but you get everything else back. So we use it for our annual savings, like property tax and items like that. We save them up in an account within the TFSA and grows tax free.
Nice.
And what place in making your money work for you do certificates of deposit play, or CDs? I guess I could call them CDs now because people don't really have CDs to play music anymore, right? So there's no more confusion there.
Definitely. I mean, it's that longer-term savings. I mean, with the CD, you get the higher interest rate than you would in your savings account, but what you do is you give up the freedom of accessing it right away without losing that interest. So if you're okay with putting your money away for 1 year, 5 years, take advantage of those higher rates. And you can even set up a CD ladder where you have different expirations. So you set up a 1 year, a 3 year, and a 5 year, and at least you have money freeing up at different times if you need to.
Yeah, I know when I started out, besides whatever was in my 401k, but for me it was all putting it in an online savings account first, because that had a better interest rate than what my brick and mortar did, and it was great seeing that extra, maybe $20 every month, depending on how much the interest was. And then from there, I moved on to getting CDs through the same online bank, and I was able to do the same thing. It was a type of a laddered thing that I did where I bought maybe about 5 different investments and kept rolling them over into longer terms. So that was a good beginning way to start making the money do a little bit more. So we talked about index funds. For those who might not know what those are, can somebody speak to what those actually represent?
For index funds, I mean, we bucket everything into them, but I mean, for a new investor, we say index funds, but we really mean like a broad market ETF, so something that maybe mimics the S&P 500, an ETF that mimics that, or something that follows like the Wilshire 2000, a broad market that covers pretty much every company in a given area, whether it's the United States or the world. It's just an ETF or a mutual fund that kind of mimics that.
And so what it is for those people that are sort of new to the world of investing, when you buy this ETF that we're talking about, an exchange traded fund, every dollar you invest in this, it takes it and it automatically splits it up into all the countries like Robert, or all the companies, like Robert was talking about, that are in the stock market in a given area. So in Canada, it's the TSX 60, so it's relatively easy to understand. You put $1 in, because RBC is 8% of the TSX 60. You end up with 8 cents of your dollar going to RBC. Obviously, with the S&P 500, it's being split in 500 directions, and so on and so forth. So you're basically buying a little bit of every company on the given index that the ETF looks at.
And when you're looking at the index, you have to still look at which particular index that you want to follow. So depending on what you want to do with your investments, there's still a difference in how big and broad you want to get. So there's different types of indices. So you can have the Dow, which is only about 30, and then you have the S&P, and then you can have it grows and shrinks as well. So people who are out there, they shouldn't know that just index fund is the magic world. Just put me somewhere in an index fund.
Well, you could always just do an all market fund and then just not worry about it at all. So.
Yeah,
And
I like the
Miranda
broad
sort
ones.
of Miranda sort of says that jokingly, but it is hard because when you're trying to talk to someone and get them to like sort of dip their toe into investing in the stock market and index, we know that index funds are the best because I mean I'll throw some stats out later if we want, but statistically they're the best and it's pretty proven. And when you start saying like, oh, there's this S&P 500, but small markets outperform, so small cap stocks are in right now, where there's different cycles, ETFs, and all these different things. And what Miranda says, like to just pick an ETF, a broad market ETF, and pick one and just buy it, it's not going to be ideal, but sometimes to start, that's just the best direction to point people in because really all you're doing is buying an average. So once you sort of wrap your head around that as an investor, that you're not trying to, watch Mad Money and see Jim Cramer throw stuff at the camera and that, then all of a sudden investing makes a lot more sense, I think.
And it's also, I think, a little bit easier for most people to get their heads around and a little less stressful as well.
Well, and I like you said, I kind of said it jokingly, but that's sort of, I mean, I've got almost everything I have is in some sort of an ETF that reflects a very broad market because I'm very boring. As Kyle mentioned before, I'm extremely, extremely boring. And so having that all market fund is sort of like saying, well, over time, the stock market has yet to lose. I mean, it could lose because nothing in life is, foolproof and past performance, blah, blah, blah. But, for the most part, having it in a broad all market fund pretty much says, well, I'm going to go with the average and I will probably come out ahead and that's good enough for me. And then
lately there's been a lot of exotic ETFs that aren't even really ETFs. They're starting to get closer to being an actively managed mutual fund anyway.
Frustrating.
And if you don't pick broad and you start to think, oh, I'm going to pick these exact things, it's almost the same as trying to pick stocks. Like you're saying you're better than everyone else that's out there. So yeah, there's no sense getting too fancy about it sometimes.
Definitely. I was going to say that doesn't take away, though. I think it's still important to, make sure you have a, a proper asset allocation. So maybe it's a little more advanced, but you don't just have to have one ETF. You can have one that does stocks, and you can also have an index fund that tracks bonds. Right. So, it's a broad, coverage of different bonds, but it gives you a different kind of asset. So typically when stocks go up, bonds stay the same or go down, but the vice versa is true. So when stocks go down, bonds typically rise, and you can buy a bond index fund as well.
I think that's a good point too. Once you get in there, you just, my mantra is you just get started. You get something easy, get something that you understand, and start that, and then start branching out and fiddling with things a little bit more in your portfolio. But the important thing is to get started.
Now, let's go back to bonds here. You were talking about a bond fund. I know when I was younger, my grandmother used to buy me a bond, I think every birthday, or every time the holidays came around. So what would be the difference between what a bond fund would be, an index fund of bonds, versus, what you're getting? What were those, the Series E's back then? So
it's the same concept as a index ETF. So instead of owning one bond like your grandma got, or maybe you got 5 savings bonds in a little envelope, well, an actual bond fund owns 100,000 different bonds, and they all have different maturities and are paying different interest rates on them, and they're just a collection inside of one fund.
And for those who might not be really knowledgeable about it yet, what is a bond? In the simplest terms, what are you getting when you're getting a bond in general? For
sure. So it's an IOU. So you're buying someone's debt. So when you're lending them money and they're paying you interest on it. So the most common one are treasury bonds, right? So we're lending the government $100 for that savings bond, and they're paying us 1% for that money.
And in that, there's all different types. You have the Treasury, you have municipal bonds, state bonds, company bonds. Mm-hmm. So when you're buying a fund, you don't have to think about all these different individual types, and you don't have to think about holding on to each one of them and all the different paperwork for it either. You're just going to buy one thing, and somebody else is going to handle all of that, and you're just buying a general representation of this bond ether, basically, to help make it easier.
Definitely.
And I think for a lot of people, it's important, like for beginners, I often say, think twice about drifting off the path into chasing, like obviously the riskier a company or a body that you lend money to that owes you an IOU, the higher percentage they're going to pay you because it's riskier to put it there, right? So that's the basic relationship between risk and reward. So a lot of people will chase this sort of higher rate payout and go after what they refer to as junk bonds, and those are companies that maybe we're not as sure about as the U.S. government or some of the other more safer bonds out there that are a little bit safer. So you might want to sort of stick close to that sort of a bond.
Right. I mean, certainly since the 80s, this junk bond has been this like enticing yet destructive thing that we hear about on the news. You know, we want to, bonds are in general, I think for the beginning investor at least, it's supposed to be the safe place for your money, right? It's not as unsexy as an index fund is. The bond index fund is going to be even less sexy than that, and it's not really supposed to earn as much necessarily as the stocks, but it's there as a safety net and to help diversify all the craziness in the stock market.
Sure, and I just point to that too, is that the bond funds typically pay you more interest though, because stocks are growing. Some companies pay dividends, but when you're owning an index or a stock ETF, you know, not all of them are. Whereas bonds, they all are paying. So typically with the bond fund, yeah, you don't get as much growth. It's not growing, it's not sexy, but you're getting more money out of it. So you're getting more cash every single month or quarterly into your account, which can be useful depending on what you're investing for.
I think that's a good. Sorry.
I was just going to say bonds are a little bit safe too, just because if worst case scenario, if a group of companies were to go bankrupt, say calamity hits, people who have bonds typically get first crack, or one of the first cracks at least, at the company's assets. So even if a company goes broke, they have land and whatever different types of assets they can sell. Whereas if you own a stock, you're one of the last people to take a crack at that. So you're much less likely in a sort of worst case scenario to get some of your money back. So that's another reason why bonds are a little bit safer, like Glenn and Robert were talking about.
Well, I was just going to point out too, I think Robert makes a good point that you've got to pay attention to what your goals are at your particular point in time. So if you're looking for income and you want something that's sort of somewhat reliable that you can rely on for income, then switching to bonds makes a little more sense because you're going to have that income, like Rob said, regularly every month. And I think you've got that too in Canada, right, with the GICs. I think that's something to bring up as well, your guaranteed income investment sort of vehicle thing. Well,
Tom or Kyle, you want to jump in on
maybe
this?
Kyle has more to add to it, but from what I've heard of CDs, it sounds a lot like GICs. To me, the same concepts of laddering and all that.
Very low risk. Your interest rates are probably going to keep pace with inflation, more or less. Not a bad idea, especially if you have low risk tolerance and you're closer to retirement.
So a bond is a little bit more of a loan. Somebody needs some money and you're willing to give it, and they pay you an interest rate. So how's that different from a stock? What are we getting with a stock?
Well, with the stock, you're getting ownership of the company. You're getting equity in the company versus holding the debt of the company. So it's just a different way to own the company per se. You're not a lender. You're an owner. And so you'll hopefully get a portion of the profits from the company if there are any, and if the company pays them out. So a good example, let's use a really popular one right now, is like Tesla stock, right? So if you own Tesla stock, you're an owner in that, but they're taking all the profits and investing them in this massive battery plant. So while your stock goes up in price, they're not paying you anything to own it. Whereas if you hold debt for the company, they have to pay their interest payments on that debt every month, and as a bondholder, you get that payment every single month. Right,
but on the flip side, like you were saying, you don't get to share in that potential growth. So if Tesla really does take off and the battery plant works out really well, if you're a stockholder, your price goes up. Maybe someday they'll decide to pay a dividend and you can get some money that way. Whereas with the bonds, there's this set agreement. This is how much they're going to pay you, and that's it.
Right. And then to Kyle's point, let's just say this whole thing just flounders and doesn't work out. As a equity holder, you're probably going to be wiped out. So if you own the stock, you're going to get nothing. But as a bond holder, they have this land and they have these patents and they have all this stuff that they could possibly sell. And you might not get it all back, but you could probably get some of your money back.
So we're making stocks sound like they're almost pretty scary. But when we say this, we're talking about buying individual company stock. So if I want Tesla or Apple or Microsoft, I can buy stock in that company, plus thousands of other companies as well. What we're talking about, what a person should probably do, is buy an index so that you're buying tens, hundreds, thousands of different companies all at once, so that if one of them does happen to tank, you still have all the others holding up your investments.
Right, because when you look at, let's just say the 50 biggest companies in the United States, a lot of those have been around for a long time, and they're going to be around for a long time to come. You got the GEs, you got Coca-Cola, you have utility companies that are providing power. Since there's a need for these companies to exist, whether the economy goes up, the economy goes down, these companies are still going to be in business.
And I think when you mentioned that you're buying a piece of the company and ownership, I think that's the thing that a lot of people don't put a lot of thought into. When you're buying a stock, you're buying that company, even if it's a little bit of everything. And I think it's nice to be able to take a few seconds and go, you're watching a commercial and you go, I have a little bit of that, That's pretty neat. And I think also when you think that way, you don't think of it as just as paper that you're going to try to trade away for another piece of paper also. When you own something, you kind of put a little more value into it. So I think that's something that a person should think about a little bit.
For sure. And I mean, that's what differentiates an investor from a trader. So an investor is someone that's in it to be an owner, and a trader is someone that just looks at that ticker symbol and is just going in and out of it and isn't in it to be in the long term or to be an owner.
So you say that.
I was just going to say, I think that trader mindset is what scares a lot of first-time investors. They see this terminology and these buzzwords and these high-priced suits, and they're going diversification and asset allocation, and we're going to do this with your money and that, and we're going to get in, and this is technical trading, and here's a graph. And you know what? 98% of it is all BS. They've got 24-hour news channels to show, and most of those guys are not invested in that stock, or if they are, they'll be invested until you buy it and get out of it quickly. And so don't even listen to that. In writing the book, there's a lot of smart people. A big investing sort of website or firm called Morningstar did a study from 2001 to 2011. People who tried to pick stocks trailed the U.S. average, so the S&P 500 average, by 24%. Another group did a famous Dalbar study, 20-year study from 1990 to 2010. The S&P 500 annually returned 9.1%. American investors got 3.8% of that. And 9.1 to 3.8 to the average person, that might not sound like a lot, but when you're looking at your retirement account over those 20 years, that's probably hundreds of thousands of dollars in difference.
We, as a whole, are very, very bad at picking stocks. And that should be made clear. I mean, even the experts who are out there don't do well every year. They might have one good year with a certain fund, but in general, when you hear about superstars like Warren Buffett, those are the exceptions to the rule for the most part.
Well, Warren Buffett's boring anyway. He's not a trader. That's the other thing. He's not a trader. He's a value investor. So.
And so a lot of his best investments he invested a long time ago, and at the same time he also is able to get investments that we necessarily can't. And so it's important to realize that as well, because he is Warren Buffett. So, he was able to invest in Goldman at preferred terms when the Great Recession hit a few years ago. We couldn't get that as an individual investor. So
go try and buy a share of Berkshire Hathaway, right? Go ahead.
Yeah.
Well, you can if you go through an online broker that gives you fractional shares.
You have to be a pretty tiny fractional share.
It would be a tiny fractional
shares
share.
How much are they now? Like 200,000 or something ridiculous?
The B shares aren't as bad though.
No.
And in buying Berkshire Hathaway, which is Warren Buffett's fund or company, really, is like buying a fund of some really excellent companies.
I don't think you can emphasize Glenn's point enough that we are biologically engineered to be bad at this game, though. And the whole idea of like buy low, sell high, and I'm just gonna gin that up in various different ways as a snake oil salesman. It cannot be overstated how difficult it is to actually pick winning stocks. And if you think you have this sort of magic strategy, you're only going to have it for a very short period of time, if you ever had it at all, before someone figures it out. So that's why I think all of us are sort of united. We're boring people in this index investing idea where your dollar that you invest in the fund is just going to get split up across all those great companies that you just talked about. And on average, you're betting that the average American or the average Canadian or the average world business person that's running a company is going to do a good job. And that's been a statistically great bet since we started keeping track.
For sure. And I think it's, really important to realize, like you said, it's to buy low and sell high, you're going against our natural instincts. So when it's low, everyone's selling and the world's coming to an end, and we don't know if the banks are going to open tomorrow, because that's what happened in 2007. And so are you really going to take your retirement savings, you saved $100,000, and you're going to invest it? Like, no, you're not, because, no sane person is going to, but that's what it takes. And so you're really fighting natural instinct to do it. So just go with index funds. It's okay.
And the other thing too is how does the average person, how does even an expert know what the timing is going to be? You have one bad day, you don't know if the day after that is going to bounce back up and go even higher or go worse. And if you make a decision based on any of that, odds are you're probably going to make the wrong decision. You're probably going to sell at the wrong times, you're going to buy at the wrong times and just mess things up. You're better off just putting everything there and letting it ride for a long time.
And we know that you're right, Glenn, because mutual fund CEOs or managers actually, by and large, have a terrible record. And again, if you're a beginning investor, you've probably heard of mutual funds as this godsend. Someone comes to your door and they're like, we won't even charge you for advice. You just invest in our mutual fund. We'll diversify your money. We've got all 5-star funds, and you're going to make a ton of cash. And there's been a ton of studies. There was a study from 1975 to 2006, the false discovery test. You can Google it, or you can check out our ebook. They figured out over those years, if you counted all the mutual funds that got sort of kicked out because they weren't doing good, too many people were leaving, so the companies just said, to heck with it, we'll just fold the fund. If they included all of those, less than 1% of mutual funds beat the average. That means that these people, all they have to do all day is look at charts and figure things out, and then they hire teams of business grads to look at charts and all these different metrics, and they can't beat the market, most of them. So that tells you two things. One, you should really think twice about mutual funds, and two, are you better than that mutual fund manager?
Now, I think we're also talking here, we're delving into the area of active funds, actively managed versus passively. Am I right there?
Yeah, that's what I was referring to, Glenn.
So,
because like an index fund is really just another type of mutual fund. It's just instead of having a manager sitting there actively picking what goes in it according to whatever criteria they set or whatever goals the fund has, when you choose an index fund, it's all passively managed. It just mirrors what's happening on a specific index depending on what you pick, which index it's following. So it doesn't require a lot of management by anybody, but it is a type of mutual fund.
So there are mutual funds there that aren't so bad. I think Vanguard has a good number of them that are very low fee. They don't have any loads, front loads, back loads. Load being this is what you're going to have to pay either beforehand or after when you try to sell it to get in or out of this particular fund. And that's why ETFs tend to be a little bit easier because they approximate what a mutual fund would be, but they kind of sell like a stock, right? Unless somebody has some better definition.
Yeah, no, they trade like stocks, yeah.
And when you're finding one that's passive that just follows an index, that's really kind of a basic place to start, and maybe a better place if you want to make sure that you're following the market and not just some manager who you're hoping can pick the right things.
The other problem with actively managed funds, too, is say you go out and you buy 5 different funds, and some are good, some are bad, so in general you're doing average. Well, not only are you similar to an index fund then anyway, but the higher management expense ratio will kind of eat away that. Like if you're losing 2% for them just to be average, then it's not helping you, and chances are they're not going to be average. They're going to be worse, like Kyle pointed out.
The fees, the fees.
Yeah, let's talk about that. What do people need to know about fees? Way back in the day, I wanted to start investing. I walked into a brick and mortar bank, one of the biggest banks in the world, and I sat down. This is in the Empire State Building, one of the tallest buildings in the world, biggest banks in the world. I'm sitting there face to face, and he starts trying to sell me mutual funds that are front loaded and back loaded. And luckily I knew at least a little bit to go, wait a second, this just doesn't sound kosher to me. Thanks for what you're saying. I'm out of here. But I don't know that everybody would necessarily know that, especially when you're sitting there with somebody who's supposed to be an expert in this. So what are the different fees out there in buying a fund that people need to be aware of? And that's just one example that I said.
Well, that Empire State Building didn't build itself, so guess who's paying for it, Glenn?
Well, they're paying for their office space at least. That bank.
Yeah, but you're paying for the office space when you buy that front load, back load mutual fund.
Yeah.
It's like Vegas. Those casinos on the Strip, they're not building themselves off of giving money out in winnings.
Yeah, I think it's important to realize that, everything you buy, you're going to pay a commission for the most part. So expect some standard commission, but it should be low. $7 or less. Unless you're at a 401k or in those companies, you're not going to see it. Then you're going to have the expense fees in the funds. So the fact is that every fund does have expenses, and they're going to make you pay for it, and every company has to make the money, so they're going to make you pay for it. But you want that to be low as well. So index funds have great low fees. So if you have a traditional index ETF, you can be at 0.25, 0.20, very low. These funds that Glenn was talking about was probably pushing 1% to 2%, like huge amounts of expense ratios or expenses that you're going to pay out every single year. So really be mindful of those when you're investing. And this is aside from those loads, which are just straight commissions to the broker.
Why are these fees so bad? I mean, a lot of them get hidden inside these funds, and you have to look at the expense ratios. Now, I want to say, like what you were saying, Robert, you're going to pay a commission usually. You're going to pay some fee. So if you see those words, it doesn't mean that it's bad. But there are some that are higher. And what does that do that's so bad with our investing?
Well, it just eats away at your return. So, if you had a 10% return this year, but a 1% fee, now you're at 9%. But if you could have a 0.25% return, you just increased your return. You increase what you get to take home. And then you compound that. You go over 20 years of that. Let's say you're in the same, index fund ETF for 20, 30 years. So you're talking, let's say a 0.75% difference compounded out over 30 years, and you can see a, $50,000, $75,000 swing in your investment.
Well, and it's even more pronounced if you look at, hidden 401k fees that you might be paying. There was a study done by Demos a couple years ago that they found that $155,000 is what kind of the average two-income earning household was leaving on the table just in fees over their lifetimes when you start compounding that. And that compounding makes a really big difference.
Right. It's what you want as an investor, right? So you're investing in the stock market because you want that compounding over time. You want that growth, but you don't want to be giving it up in fees because those fees compound and grow as well.
And two quick points on that. In Canada, those fees are even higher. Canada has the honor of being the highest mutual fund fees on the planet. Actually, our average is 2.1%, and you're going to get a lot that are in that 2.5% MER category. And it should be mentioned that it's bad enough when you subtract 2% from 10%. What about if the market has a down year and you're down 30% at the end of the year? No, the mutual fund companies don't say, or the active management companies don't say, oh, hey guys, you know what? We had a bad year. We'll shave a little off this year. No, the yachts still have to get bought. The building still has to be paid. So we're still taking that 2.5%. Now you lost 32.5% instead of 30%. So you can't. Fees are one of the few things you can control all the time in investing. So it's worth paying attention to.
Definitely. There's like here in the United States, there's probably about 40 to 50 different S&P 500 index funds. They all invest in the S&P 500. So you get the same 500 stocks no matter how you slice it. So you might as well just pick the one that has the lowest fees because you're getting no difference in the actual fund. So if Vanguard has a really low one, but your brokerage is at 0.5 and Vanguard's at 0.3, go with Vanguard. It's the same 500 stocks. No difference.
Where generally are some good places to look? Now, not that any company that we're going to mention always has the lowest price. You always have to do your own research. But generally speaking, if somebody wants to buy a fund that is a good index fund, where should they be looking?
I mean, I think, Vanguard always is top notch for the most part. But then most of the large investment companies here in the United States, Fidelity, T. Rowe Price, most of the ones that are just standard index funds are usually very low expense ratios. The benefit you sometimes get by sticking with the firm you're at is that you don't pay some commissions. So whereas if your 401k or IRA is at Fidelity, if you stick with Fidelity's S&P 500 index fund, they usually say, hey, no commission since you're sticking with us. And if their expense ratio is comparable to Vanguard's, which it typically is, it might be a better deal for you.
I also really like Betterment. So, I mean, that's kind of outside like the traditional realm of things, but I think that's a good place to start. You won't be picking your own index funds or ETFs unless you hit their threshold account size, but it's still a good place to go. It's low cost. It takes a lot of the hassle out of it, and you don't have to worry about transaction fees.
Can you go just a little bit into what they do? I don't know that everybody understands what Betterment is.
Yeah, so basically they're just they're a brokerage. They're another discount brokerage, but instead of having you choose what you're going to do, they take a look at your risk profile and your asset allocation and put together a portfolio for you. So they choose your index ETFs for you. So they do it all with ETFs. And it's all low-cost ETFs, and then the fee is based on how large your account is. And basically, you either have to put in $10,000 or you have to commit to doing $100 a month. So if you can't commit to $100 a month, then Betterment isn't for you. But it's a great way to start because it sort of forces you to get into that automatic investing, which is another way to start getting your money going, is this consistency and this dollar cost averaging.
There's two options in Canada that I really like. TD Bank has the E-Series funds. They're very low cost, a little difficult to get into because you're supposed to do it all online, and they got some messy paperwork. But more recently, Questrade that already has like 495 trades. Not too long ago, they started with ETFs. You buy ETFs for no commission. They still have the regular commission when you sell, but you can buy ETFs with no commission. So I've been doing that a lot more with different iShares and Vanguard ETFs.
And I just want to talk about commissions for a sec. The idea of a commission, that's how much a brokerage is charging you to either buy it or sell it. So every time you're going to buy this fund, stock, whatever it is, you're going to usually pay this fee. So when we talk about trading often, not only do you have the possibility of making mistakes, of selling at all the wrong times, but you're going to also get these commission fees adding up too. So even when you first buy a stock, even if your commission is only $5, you're not really getting anything until your stock either gives you $5 worth of dividends back or goes up $5 before you've actually made any money.
Definitely, and there's a new company it's a startup, and it actually just got a bunch of funding from Google. It's Robinhood.io, and they are going to be a commission-free platform when they get going, which is a really interesting kind of concept. It has a bunch of high-powered Silicon Valley people behind it trying to change the structure of the market.
And I think Loyal 3 is another one that has a different kind of commission structure.
I believe with Loyal 3, there's only a certain amount of companies that you can invest in, but they are all free of commissions. Right. So that is nice. And the thing, I think, with a company like that, Loyal 3 sounds great, and it could be a great way to get into those particular companies. You just don't know long-term what the fee structures are going to be, because I remember there was a Zecco, and they also had free. And then they were bought by Trade King, which also has very low commissions, but it's not the same thing as free.
Right.
So don't be afraid of these companies, but just keep in mind that things do change over time. And I think something like that where if you're that worried about the commissions being low because of what you're trading, maybe you're trading too much.
Good point.
Unless you know I'm always going to put money in, like every month I'm going to buy a part of a fund. But,
well, yeah, like Tom was saying, with companies that allow you to buy ETFs for free and charge you on the sales, to me, I laugh because I say, yeah, I can do all my ETF investing for free because I don't want to sell any of those ETFs for probably 30 years as a young guy. Like, for sure 20 years. So to me, that's hilarious. I'm going to buy this thing for free and let it sit there for 25 years, and then I'll pay a very tiny, tiny percentage when I take it out on the back end. I'll take that deal any day.
Right. So what you're saying is, let's say it's free, but it costs you, let's say, $10 to sell it. But you're hoping 20, 30 years down the line that this thing has grown so much that $10 is nothing. You'd be happy to eat that $10 because you're going to get so much more back out of it.
Yeah, I'm not paying $10 to trade that thing 4 times a day while I'm watching BNN or whatever.
Right. It's not such a bad thing. Before we wrap up, let's maybe talk a little bit about risk. I think we talked about that when we talked about maybe getting bonds versus stocks. That's kind of one way to mitigate a risk. But in general, like part of what we're talking about here with index funds in general is to avoid risk. So how does a person understand what their risk is, and how do they work around that with their investments?
It's the tough one. Is you have to know what risk tolerance you're willing to have, and it's a kind of combination of factors. So it's the time you have, right? So if you have a longer time horizon, you have more tolerance for risk, because if it goes down next month, you got 20, 30 years for it to go back up. So I would say time is a big player, and it's just your own emotional intelligence as well, like what you're comfortable with. So, I think it's important to realize that risk goes both ways. There's the risk of your portfolio going down in the short term, but there's also the risk of you not achieving the goals you want in the long term because your money's not growing and working for you.
And I think it's also important to remember there's always a trade-off when we talk about things like savings accounts and CDs and putting your money there. There's a lower risk in terms of whether you're going to lose your principal. But at the same time, like Rob was talking about, there's the risk that your money isn't going to grow fast enough. I mean, basically, if you're looking at greater security, you're going to have less of a chance for growth. And so you have to kind of weigh that and find a place where you kind of find your happy medium between growth and a little bit of security. Because, if you just rely only on CDs and savings accounts, then you aren't going to grow that money fast enough. And then you run into the risk of inflation, but that's a whole other issue. But yeah, you have to watch out for that.
Quick word of caution, and studies would say that us guys are especially susceptible to this. I can almost guarantee that you're going to think when you first get into it that you have a higher risk tolerance than you do, because earning 10% sounds so much better than earning 2%, and you're going to be like, yeah, I'm a maverick, I'm ready to go, right? Like, sign me up for these 10% returns. I can ride it out. I can lose 40% in a couple months, like back in 2008, not lose any sleep. And statistically, again, you're almost guaranteed to be wrong. A lot of people that thought they could hold on to stocks forever in 2008 started falling, and they sold, and lost a ton of money. So really, it's really important. There's a lot of things you can do online. This is actually one of the few things that I would recommend you talk to a financial advisor about. There's good financial advisors that will charge you an upfront fee that's very open and transparent, and they can tell you what your real risk tolerance will be, probably better than most internet tests can.
So one thing we like to do at the end of the show is wrap up with a final word from everybody. So we'll go around the panel and get a final word on putting your money to work for you. Tom, let's start with you. What's your final word on putting your money to work for you?
Well, really, investing doesn't have to be difficult. Like we said, we talked about index funds and ETFs. You get a handful of those. Like here we basically try to cover Canada, the U.S., international, and then bonds. 4 ETFs could cover you for so much, and they're easy. Like I said, you can pretty much buy them for free, and they have almost no expenses related to them either. So super simple, super cheap.
Miranda, what's your final word?
So think about getting started, because the bottom line is you're either working for your money, which means you're just working and trying to save it and put it away and just trying to build it up as, kind of your end result, or your money is working for you, gaining compound interest and compounding your efforts so that later on you have a bigger nest egg and you've grown your wealth. So I think getting started is really important as far as investing and growing your wealth, because you really do want your money to do most of the heavy lifting instead of having to work so hard and so long.
And Kyle, what's your final word on making your money work for you?
If you really want to make your money work for you intelligently, it can be certainly easy rather than difficult, but understand what you're investing in. Take a Sunday afternoon, read The Small Book of Common Sense Investing by John Bogle. I guarantee it's a quick read. He's the guy you've been hearing us talk about, Vanguard. He's one of these titans that started this thing like decades ago, before my parents were even born. So he knows this stuff. He's great at explaining it, and the stats and the math are pretty easy to follow. If you pass grade 9 math, you'll be able to see why index funds are a great way to go.
And Robert, what's your final word?
You just have to get started. Don't be fearful of it. Just dive right in, and you're going to make a mistake. It's okay, because the goal is you're going to be invested for the long run. So read up, take this advice, and get started today.
Sounds good. I feel like there's so much more we could have talked about. Investing is a whole world of discussion. We didn't really talk too much about allocating and diversifying, and there's so many other different forms of investing that we could have gone to, but I think we did a good primer here for somebody that wants to invest and they don't want to be too confused and they really just want to get in there and do the right thing. So, Robert, thank you for joining us. For those out there that aren't familiar with your work, why don't you tell them a little bit about what you're all about and where they can find you?
Definitely. Well, I'm all about helping young adults and millennials get out of student loan debt and start investing in their futures. You guys can find me at thecollegeinvestor.com. Got a ton of stuff, Investing 101 on how to get started, so that you can do some reading before you get going this weekend. Thanks again, Robert. For those that are out there, we love comments. If you have any questions regarding what we've discussed tonight, please come to our site. Once our page is up for this particular episode, feel free to drop a comment there or on any article, and we'll get back to you on that. So thank you for joining us at the Money Mastermind Show. Until next week, be good with your money.
Thanks for joining us on the Money Mastermind Show. Get more information at moneymastermindshow.com. Don't forget to subscribe to the show on iTunes and YouTube, and follow us on Google+.